BlackRock just dropped their fourth quarter 2025 earnings, and the numbers are absolutely staggering. We're talking about a company managing $14 trillion that somehow managed to post 12% organic growth. If you think growing gets harder at scale, BlackRock is proving everyone wrong. Let's count down the 10 most important takeaways from this earnings call that show why this asset management giant is just getting started. At number 10, we have BlackRock's emergence as an Asia growth engine. The company delivered double-digit organic base fee growth across both Asia and Latin America in 2025. What's driving this? It's the fundamental expansion of capital markets in these regions. Larry Fink pointed out that Asia is now seeing more IPOs than the United States, particularly in Hong Kong. In Japan, the NISA retirement accounts are pulling wealth out of the banking system and into capital markets. And the Jio-BlackRock partnership in India raised $2 billion at launch, 6 times the previous industry record, and now serves nearly 1 million retail investors. This isn't just geographic diversification, it's BlackRock positioning itself at the center of the next wave of global wealth creation. Coming in at number 9 is BlackRock's systematic equity franchise becoming a genuine star performer. The systematic equity platform raised over $50 billion in 2025, even as the broader active equity industry saw outflows. Their flagship systematic equity factor rotation ETF, DYNF, was the highest inflowing active ETF in the entire industry with $14 billion in net inflows. This platform has been using data and AI for 20 years, and it's now delivering thousands of alpha signals to drive returns. It's a bright spot in active equity with double-digit organic base fee growth potential. Number 8 highlights BlackRock's position as an insurance powerhouse. They're the largest general account manager for insurers with $700 billion in assets under management. With the HPS acquisition, they are now positioned to help insurance companies migrate roughly 10% of their public fixed income assets into private high-grade credit. They have over 20 late-stage conversations happening right now with leading insurers. This represents a massive opportunity to shift $70 billion from public to private markets, generating significant new base fees while delivering better outcomes for insurance clients. At number 7, we see BlackRock's absolute dominance in active ETFs. They pulled in $50 billion in active ETF inflows during 2025, nearly tripling their assets in just 1 year. Rick Rieder's Flexible Active Income ETF, BINC, and the Systematic Factor Rotation ETF, DYNF, led the charge. This isn't just about flows, it's about BlackRock using the ETF wrapper to democratize access to their best portfolio managers and strategies while capturing the structural shift from mutual funds to ETFs. Number 6 focuses on the pre-chain integration and what it means for private markets. BlackRock is building investable private market indices, standardized pricing frameworks, and comprehensive benchmarking tools. Martin Small laid out the vision. They want to do for private markets what index creation did for public stock markets. This includes building the infrastructure for futures contracts and ultimately iShares products based on private market indices. For the 80% of investors who plan to maintain or increase private credit allocations, pre-chain provides the language and measurement tools they need. At number 5, BlackRock is aggressively expanding into the wealth channel with new products. They are launching an H-Series family of funds to provide building blocks for wealth investors, direct lending, junior capital, real assets, triple net lease, and multi-strategy credit. The flagship HLEN BDC has been raising about $1 billion per quarter, and they're targeting $60 billion in AUM across these private markets to wealth products by 2030. A real asset strategy is coming soon, followed by European direct lending and triple net lease strategies later this year. Number 4 is perhaps the most exciting for retail investors, private markets coming to 401k plans. BlackRock expects to launch their first LifePath target date fund with private markets allocation later in 2026. This is a potential game changer for retirement savers. Fink emphasized that helping workers build retirement savings is one of the greatest challenges of our generation, and bringing additional returns and diversification through private markets could make a meaningful difference. With their leading defined contribution business, $600 billion LifePath franchise, and Preqin's benchmarking capabilities, BlackRock is positioned to lead this transformation. Coming in at number 3 is the technology revenue surge. BlackRock posted 16% technology ACV growth in the fourth quarter, driven by innovative multi-product wins integrating public and private markets. Aladdin is becoming essential infrastructure as institutional investors add private markets to their portfolios. As Fink noted, if private markets enter the 401k space, every firm will need comprehensive risk tools to validate and authenticate the risks. This positions Aladdin for significant growth as the industry's essential operating system. Number 2 showcases the record-breaking iShares business. The ETF platform brought in $527 billion in net inflows during 2025, growing assets to $5.5 trillion and generating over $8 billion in revenue. That's more than quadruple the revenue since BlackRock acquired iShares in 2009. The growth is coming from both core channels and premium initiatives like active ETFs, digital assets, and international expansion. In Europe alone, ETF inflows jumped 50% to $136 billion. iShares isn't just a product, it's an innovation engine driving margin expansion and democratizing access to capital markets. And at number 1, the most important takeaway is BlackRock's historic organic growth momentum. They posted 12% organic base fee growth in Q4, finishing the year with $698 billion in total net inflows. They delivered 6% or higher organic base fee growth every single quarter in 2025, ending with back-to-back double-digit quarters. This growth is entering 2026 with base fees 13% higher than 2025, approaching $21 billion. The company responded with a 10% dividend increase and planned share repurchases of $1.8 billion. BlackRock is proving that with the right platform spanning public markets, private markets, and technology, scale is an advantage, not a limitation. They're positioned to continue this momentum and deliver significant value to shareholders.